Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Peloton's proxy statement, and let's just say this filing is like a super detailed instruction manual for how they're planning to run things and how they want you to vote. Get ready for a lot of numbers and a peek behind the curtain of executive compensation. And hey, if you love getting the real story from these corporate reports, smash that subscribe button and join our Discord community linked in the description. We break down the nitty gritty so you don't have to. Alright, so Peloton is holding its 2025 annual meeting of stockholders on Tuesday the 9th of December 2025, and they're doing it virtually. That means no showing up in person. You got to log in online to www.virtualshareholdermeeting.com/Peloton2025. They're really emphasizing that your vote is important, whether you attend virtually or not. You can vote by internet, phone, or mail. It is all about making sure your voice is heard on the big decisions. The main agenda items are pretty standard for a shareholder meeting. First, they need to elect 3 Class III directors. These directors are basically the brains behind the company's strategy and will be serving for 3-year terms. Second, they want to ratify the appointment of Ernst & Young LLP as their independent auditors for the fiscal year ending the 30th of June 2026. Basically, they're asking you to approve who is going to check their financial homework, and of course they always have a catch-all for any other business that might pop up. The record date for voting is the 15th of October 2025, so if you own stock by then you get a say. And a key detail here, each share of Class A common stock gets you 1 vote, but Class B stock, which is usually held by insiders, gets you a whopping 20 votes per S-share. That is a significant power difference. This whole document is basically a guide to the meeting, starting with a quick rundown. We see they're focusing on electing directors and ratifying the auditors. They also provide a brief overview of who Peloton is, a leading global fitness and wellness company. As of the 30th of June 2025, they had about 6 million members. Now, let's talk about how the company is run. Peloton says they're committed to good corporate governance. They want to highlight that most of their directors are independent, which is a good sign. They also have an independent chairperson of the board. Plus, all the key committees like audit, compensation, and nominating are made up entirely of independent directors. That is crucial for fairness. They've also been refreshing the board, with over half the directors joining since 2022, which can bring in new perspectives. Here is where it gets interesting: the executive compensation. Peloton's philosophy is to attract, motivate, and keep top executive talent while keeping stockholders' interests in mind. They emphasize a compensation structure that is heavily weighted toward at-risk pay, meaning a good chunk of their pay is tied to performance, not just a fixed salary. They use things like performance stock units, SUS, and have multi-year vesting requirements to encourage long-term commitment. Plus, they have stock ownership guidelines for execs and directors, and a policy to claw back pay if there is financial restatement due to misconduct. Looking ahead to fiscal 2026, they've redesigned their executive pay. They're cutting base salaries, introducing an annual cash bonus tied to performance goals, and increasing the percentage of pay that comes in the form of those performance stock units. They really want to double down on that pay for performance idea. This section just reiterates how they're getting the word out and how you can vote. They're using the internet as their primary way to send out materials, which is great for saving trees and money. They remind us that only stockholders of record on the 15th of October 2025 can vote. And here is a critical point on voting rights. Class A stock gets 1 vote, but Class B stock gets 20 votes per S-share. This means a small group of Class B shareholders can have a massive impact on the outcome of votes. Here is the rundown on the director nominees. They're proposing Karen Boone, Chris Bruzzo, and Tara Camonte to serve as Class III directors. Their experience is highlighted, including roles at Restoration Hardware, Deloitte, Electronic Arts, Starbucks, and WW International. The company believes these individuals have the right skills and experience, like executive leadership, technology, consumer product strategy, and finance to guide Peloton. Let's look at Karen Boone. She's been on the board since 2019 and even served as interim co-chief executive officer. She's got a strong background in finance from Deloitte and experience at Restoration Hardware. Chris Bruzzo, a director since 2023, brings a ton of experience from Electronic Arts, Starbucks, and Amazon, focusing on marketing and brand management. Tara Camonte, a newer board member, has a deep history in corporate strategy and finance with roles at WW International, Shake Shack, and Getty Images. These are the folks they want in charge of major decisions for the next few years. We also see the directors who are continuing their terms. This includes Jay Hogue, the chairperson of the board and a TCV co-founder who brings VC insights. Then there is Angel L. Mendez, who chairs the audit committee and has a strong supply chain and tech background from Cisco and GE, and Peter Stern, the CEO and president, who joined the board in January 2025 and has extensive experience in subscription businesses from Apple and Ford. Finally, Pamela Thomas-Graham, with a diverse background in finance, media, and consulting from Credit Suisse and CNBC. It looks like they're trying to balance seasoned executives with fresh perspectives. This table shows how much they pay their directors. Non-employee directors get equity awards, mainly restricted stock units, and an annual cash retainer. For example, in fiscal 2025, directors like Karen Boone and Chris Bruzzo received a mix of cash and stock awards totaling over $200,000 to nearly $300,000. It is a pretty standard package for board service designed to align their interests with shareholders. This is the proposal to approve Ernst & Young LLP as their auditors for the upcoming fiscal year. They've been working with Ernst & Young since 2017, and the fees for fiscal 2024 and 2025 are listed. For fiscal 2025, the total fees to Ernst & Young were over $5.5 million, mostly for audit fees. This is pretty typical for a company of Peloton's size. The audit committee reviews and approves all these services. The audit committee of the board takes its role very seriously. They oversee the company's financial reporting and internal controls. They've reviewed the financials with Ernst & Young and are recommending that the audited consolidated financial statements be filed. They rely on management and the auditor's reporting, but emphasize that their oversight doesn't guarantee perfect accuracy, which is a standard disclaimer. Here is a look at the executive team. We've got Peter Stern as CEO, Elizabeth Coddington as CFO, Nick Caldwell as Chief Product Officer, Jen Cotter as Chief Content Officer, Charlie Kirol as Chief Operating Officer, and Diane Camp-Sanders as Chief Commercial Officer. These are the people running the day-to-day operations. This table is super important because it shows us who actually owns big chunks of Peloton. The Directors and Named Executive Officers section shows their holdings. For example, Nick Caldwell has a significant number of shares, and Elizabeth Coddington also has a substantial amount. What is really I? Opening is the other 5% stockholders section. Entities affiliated with TCV, which is likely Technology Crossover Ventures, hold a massive chunk of both Class A and Class B stock, with Class B being over 98% of the Class B shares outstanding. That is a huge amount of voting power controlled by one group, the Vanguard Group, Fidelity Investments. BlackRock and T. Rowe Price are also significant institutional investors. Now for the juicy part, the details on executive pay for fiscal 2025. They cover the named executive officers, including the CEO Peter Stern, and others like CFO Elizabeth Coddington and Chief Content Officer Jen Cotter. They also mentioned former interim CEOs Karen Boone and Chris Bruzzo and former Chief Supply Chain Officer Andrew Rendich. They want us to know that while Boone and Bruzzo were named execs, their compensation packages were different because they were interim roles. Let's look at how the company performed in fiscal 2025, which ended on the 30th of June 2025. They generated $333 million in net cash from operations and $323.7 million in free cash flow. That is a big improvement. Revenue was $2.49 billion, a slight drop. Net loss was $118.9 million. But that is also a significant improvement from the year before. Adjusted EBITDA was $403.6 million, a big jump from the previous year. It seems they're making progress on profitability and cash flow. They're aiming for at least $200 million in free cash flow and $100 million in cost savings for fiscal 2026. They kept base salaries the same for most execs in fiscal 2025, but are planning to reduce them for fiscal 2026. They also introduced performance stock unit awards, for the first time tied to free cash flow goals. A big chunk of their pay is in stock awards, and SUS, which is considered at risk because its value depends on company performance and stock price. Peter Stern, the new CEO, got a big new hire package, including a $1.25 million base salary, a potential 100% bonus, and a whopping $20 million in equity awards, plus a $1 million signing bonus. That is compensation designed to attract top talent. For fiscal 2026, they're really revamping things. Base salaries are going down for most leaders, but they're adding an annual cash bonus that can be a significant portion of their pay. The target bonus is 20% of the reduced base salary in fiscal 2026, climbing to 60% in fiscal 2027. Performance stock units will also make up a larger portion of their long-term incentives. This is all about linking pay more directly to performance. The main parts of executive compensation are base salary, short-term incentives, and long-term incentives. For fiscal 2025, base salaries for most named executive officers were around $1 million, except for CEO Peter Stern, who had a higher salary due to his new role. Short-term incentives, meaning cash bonuses, weren't a thing for most execs until fiscal 2026, but Peter Stern did get a significant bonus as part of his hiring package. This table shows the equity awards granted in fiscal 2025. The grant date fair value for these awards is substantial. For example, Nick Caldwell and Elizabeth Coddington received RSU awards valued at over $4.4 million each. Peter Stern's new hire awards were even more impressive, with stock options, REs, and SUs totaling around $20 million in grant date value. These awards have vesting schedules, with some vesting over multiple years to encourage executives to stay with the company. The SUs in particular were tied to free cash flow performance. And in fiscal 2025, the company exceeded those targets, leading to higher payouts of vested shares. This table shows what equity awards like options and RSs are still out there for named executives as of the 30th of June 2025. Peter Stern, for instance, had a substantial amount of unvested RSs and SUs, showing the long-term incentive structure at play. The market value of these unvested shares can be quite high, reflecting the company's stock performance. This section details what happens if an executive leaves the company, especially in cases of termination without cause or resignation for good reason, or if there is a change in control. They have a severance plan that provides for cash payments and continued medical benefits. In a change in control scenario, these benefits can be significantly enhanced, including full acceleration of equity awards. Peter Stern's agreement is particularly generous, with 2 times his base salary and target bonus in severance and extended equity vesting acceleration. This is common in executive contracts to provide security and align leadership during potentially turbulent times. This is a required disclosure showing the ratio between the CEO's pay and the median employee's pay. For fiscal 2025, Peter Stern's annualized total compensation was about $19.5 million, and the median employee's pay was around $182,512. This results in a CEO pay ratio of 107 to 1. Keep in mind that these ratios can vary a lot between companies based on how they calculate median employee pay and how much of the CEO's compensation is tied to long-term equity that fluctuates with stock price. This table tries to show how Peloton's pay practices line up with their financial performance over the last few years. It compares the total shareholder return to a peer group and also looks at net income and free cash flow. For 2025, we see high compensation actually paid to the CEO, while net income was negative. But free cash flow was positive. The compensation actually paid is calculated differently than the total compensation in the summary table, often reflecting the fluctuation in stock prices and equity award valuations. It is a complex table, but it aims to show if executive pay is really tied to the company's financial health and stock performance. This table outlines the total number of shares available for issuance under Peloton's equity compensation plans. As of the 30th of June 2025, there were over 76 million shares reserved for exercise of outstanding options and rights, with a weighted average exercise price of about $21.51. There were also over 61 million shares available for future issuance. This shows a significant amount of equity compensation outstanding, which is common for tech and growth companies. This section confirms that other than clearly disclosed director and executive compensation, there weren't any significant transactions involving related parties that exceeded $120,000. They also have a policy requiring the audit committee to review and approve any related party transactions. Here, they cover standard details like how stockholders can submit proposals for future meetings and how to access company reports. They also mention householding, where multiple shareholders living at the same address might receive only one copy of the proxy materials to save on costs and resources. And they note any past due Section 16 filings, which are reports on insider stock ownership changes. It appears there were a couple of minor, unintentional administrative delays in filing for Ms. Boone and Mr. Hogue. This is the wrap-up, basically saying there is no other planned business for the shareholder meeting besides what is already been listed. This annex is crucial for understanding Peloton's financials. They define adjusted EBITDA, which removes certain expenses like stock-based compensation, depreciation, restructuring costs, and other unusual items. They explain why it is useful for investors, like comparing performance across companies. However, They also clearly state the limitations of this measure. The table for adjusted EBITDA shows a positive $403.6 million for fiscal 2025, a huge improvement from the prior year's $3.5 million. Free cash flow also shows a massive jump to $323.7 million in fiscal 2025 from a negative $85.8 million in fiscal 2024. These are really strong positive trends in cash generation and profitability. So what is the story here? Peloton is clearly in a turnaround phase. They're focusing intensely on improving profitability and cash flow, and the numbers for fiscal 2025, especially the free cash flow and adjusted EBITDA, show they're making real progress. Their executive compensation is heavily tied to performance, particularly with the increased focus on SUS and a redesigned bonus structure for fiscal 2026. The significant ownership and voting power held by TCV and other institutional investors means that major decisions and board composition are heavily influenced by these large shareholders. While the company is showing signs of financial recovery, the high level of executive compensation, especially for the CEO, and the large equity awards are notable. You have to wonder if they can sustain this positive financial momentum going forward, especially with the competitive landscape in fitness. It looks like they're on a better path financially, but the long-term success will depend on continued innovation and effective execution against their stated goals. Alright, that is our deep dive into Peloton's latest proxy filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And don't forget to subscribe for more straightforward breakdowns of corporate documents, and for even more insights and to connect with us, check out the Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.